Great. So this is awesome. We are here today with another Skull Session event. And today we have Kevin Schoovaerts here with us. He has a Substack at mosinvest.com. You can follow him, find him at the Substack also by, if you're on Substack, using the moniker at Most Invest. So we're going to get into how Kevin and I connected on my Substack, which is mscliffnotes.substack.com. And I'll tell you why, kind of a little serendipity. I think it makes this a good conversation. But before we do that, let's get into the terms and conditions, and then we'll start talking to Kevin. So hang on one there a second, Kevin. All righty. So Kevin, good.
Yes, thanks.
Good to do this. Now, I think I'll give a little background. I don't know if you contacted me or I contacted you, or just happened organically through maybe I saw one of your articles. I can't remember.
Yeah, it was something like that. One of the articles, and I think maybe you commented on it, and then we hooked up, and yeah,
But
it's
I know
pretty organic.
the one thing that got kind of attracted me right away when I saw, the word quality, because I know my staff and I we were always talking about, you know, our Substack and about how quality is a big part of our process with the Substack, like GARP and quality. But we're always wondering, is that going to pigeonhole us in a kind of, a small can there? And I'm all about the quality, and I think you can make enough money in quality. And of course, you can invest in stocks that aren't in quality yet, but then we saw that will turn quality wise. Then I came across, so I used you as an example. I said, hey, look, there's a guy here doing quality on Substack. He's doing well here, and you can have a process on quality, and I think that's kind of what you're kind of all about to some degree. And
Yeah, the main theme, I think the complete title for the Substack is 100 Bagger Hunting, because it's based on Chris Meyer's book, and of course Chris's book is based on the 1972 book of Phelps, returning 100 to 1. But if you look in the book, it's mostly talks about quality investing. Um, and I started with that on the website, but I gradually started writing more and more about microcaps too. And that's why we're going to get into it later. But I call it the yin yang strategy. It's like the black and white in investing.
excellent. So before we get into that, I know we have a few slides here to help us take us through everything, and I appreciate you putting this together. Give us your background. It seems like many other investors that you didn't start out as an investment career. It's kind of something you've leaned into.
Yeah, sure. I have no financial background whatsoever. So I live in Belgium, by the way. So I'm a married man with a little son, 8 years old. And I have a pretty normal trajectory. Went to high school, went to college, got my engineering degree. But even during college, I was always interested in business. So I'm not really focusing on stock markets, but mostly reading a lot of business books, thinking about starting an own company. So getting deep into the business side of things. But eventually, because I got my engineering degree and afterwards I got a specialization in nuclear engineering, I went to work for what was pretty logical, a nuclear power plant. And I've been there since for 17 years now. As a deputy director of the maintenance department. So I do this on the side as a part-time investor for more than a decade now. And I took accounting courses and valuation with Professor De Moderan and etc. to get myself comfortable with the numbers, and that's why I started investing, and that's a bit in short the short story.
Yeah, it's pretty funny because a lot of, I think you find your story kind of common. A lot of the investors we run into that are becoming part-time to full-time investors came from an engineering background. I don't know.
Yeah, okay, yeah.
I don't know what it's about the engineering background, but it's maybe it's analytical to some degree, and that's why, and the way you think. But I know with with Geo, there's so many subscribers who are actually have to have that background too. So I mean, so take me to your evolution of a stock picker. What were the first type of stocks you were buying? I mean, did you start in the big caps? Did you start basically where Peel Lynch style, where you're looking at stocks in your industry? I mean, give me an idea how that's evolved over time.
Yeah, sure. Yeah, it started with a big mistake because the biggest mistake I made was trusting my bank. Because more than a decade ago, I didn't know what I was doing. So the first thing when I had some money on the side that I could play with, I went to my bank and the bank offered me a new IPO. It was an IPO in the Belgian market in a pharmaceutical company or a biotech company. Um, I didn't put a lot of money in, but that was the first time I didn't really know what I was buying. I looked into the company, but I didn't look into the annual report or anything. And of course, I think last year or 2 years ago, the company went bankrupt. So it was I lost all my money on it. I kept it hoping it could regain any profits, but I just well, let it go because in the meantime it was a very small position. So that was the first step. But then of course, when I got more serious, I think the typical things like reading all the books on Buffett, Lynch, and Greenblatt, everything I could get my hands on, or reading books and books and books. But the problem with books is there is like a law of diminishing returns. The more investing books you read, it's always a bit repetitive. It's the same, and I think now the thing I still read a lot, but I focus more on just going through annual reports because I learn a lot more going through the reports and the financial statements from the different companies and trying to get through as many companies as possible. And that's where the real learning comes from. So from that first mistake, I also tried commodities and etc. But finally, I landed on fundamental analysis and yeah, just buying in the public markets. I have some private investments, but mainly in the public markets. Yeah.
Okay, and then were you basically buying local stocks in your home country, or were you going outside? And then
No, I immediately went outside. Yeah,
okay.
I first focused on the US, but now since I'm hunting more and more in the microcap space, I'm finding more opportunities like in Australia, in the UK, in Poland. I have one position in the US, I think. So it's a bit worldwide, but nothing in
Mhm.
my own country. I'm afraid my own country doesn't have a great reputation on the stock market. So yeah.
Have you well, yeah, you had your first one out of the gates was not good. But
No, no, no. Maybe that's why.
yeah. Yeah,
Yeah.
yeah. All right, cool. Um, yeah, I mean, I think there's so much opportunity in the US, just North America, when you look at US and Canada.
Yeah,
And
sure. Yeah.
I think what you hear a lot from investors that don't live in the US, they find out that just the valuation multiples get a little more, I think, rewarded here
hmm
sometimes versus international markets where they can be lower sometimes.
Yeah, and
Um,
you can have a similar company in Europe and in the US, and the multiple in US will be higher, or there is more chance that there will be more higher multiple will be given.
sure.
And I think that the general culture on business growth, etc., is just more suitable in the US than in Europe because of all the regulations and yeah.
And do you remember you bought your first smaller cap company? I mean, can you pinpoint that kind of moment where you just naturally evolved?
Uh, yeah, I think it was a small cap company. I think the second one I bought after the biotech was a smaller company, but was in the gold space. I think the name was Goldfields. I'm not sure. Maybe it's Canadian.
Hmm.
It's a long time ago now. But I don't invest in commodity related companies anymore because it's already difficult to do a thesis on or an analysis on just a company and a business model and trying to predict where it will go. If in addition I have to develop a model for supply and demand to correctly predict or try to predict the future price of a commodity, it becomes too complicated for me. So I try
Hmm.
to stick to to non-commodity or companies.
Okay, excellent. So, well, maybe this is a good time to get into your strategy a little bit. And then I'd like to hear some of, some of your expertise areas you like to invest in, what
Hmm.
industries, but maybe you can talk about the crux of your strategy. I think you said here, yin yang strategy, you have it on the slide here. Maybe we can talk about that a little bit.
Yeah, so in the past, I was more I looked at the more popular companies, and this is like I don't know 7 or 8 years ago. I think like a lot of investors or retail investors looking at the Apples and the mainstream companies. But then gradually, I first always had like a focus on quality in the sense that I don't like companies with a lot of debt or companies in distress. The company needs to generate something. There has to be growth, so there has to be certain quality metrics. And in the yin yang strategy, I call this the yang. It's like I'm a big Star Wars fan, so it's like the light side of the force. You have the high quality companies, but the big problem with the high quality companies is they usually are priced to perfection or even overpriced. So what I try to do is I have more like a buy the dip list, and then I wait. I patiently wait. I could buy them. I see a lot of investors buying quality companies at like PEs of 30 or something like that. But you have to be really sure that the future growth of the next 10 years is locked in if you really want to have that return. Because the slightest downturn in growth will you will have a double whammy effect on the PE, and it can go down really quickly.
Mm-hmm.
So I try to. It's like I think in the slide in your presentation you talked about GARP, so growth at a reasonable price. For me, it's like more QARP, quality at a reasonable price. It's like yeah,
I
it's a
like
bit the same
that.
thing. Yeah,
I'm about to steal that from you.
yeah, no problem.
I
But
know I was reading your Substack too, and you kind of said, I don't know what the actual um, reference, what you're talking about necessarily, but you said it's really not you're really stressing that the most important part about investing is um, investing in an area that people are ignoring, where you have
yeah,
an edge. And I think it was maybe I think you were talking about, I think it's an article you wrote today, maybe about spinoffs potentially, and you have spinoffs
yeah,
here.
true, true. It
So
was
I guess you're talking about just finding these companies before everyone else does, and the way you do that is by kind of investing in these areas that maybe aren't well traveled or maybe
yeah,
shunned, right?
yeah, and that's why I call it like the yin is the dark side. So the where nobody's looking. And if like you said, if you do the analogy, the light side is fishing in a pond with a really big fish, but the problem is there's a lot of fishermen. And when you go into the dark side, you have the pond with the fish, but the fish might be a little smaller, but there's nobody around, or very few people around, and that's the analogy. And I started looking at this like I think 3 or 4 years ago, also through reading to meeting writings about like Ian Castle or Paul Andreola or other pretty well-known microcap investors. And I was drawn to it because there's a certain logic to it. Because you can look for the best companies, but in the end, it's always about price. And so instead of looking for the best companies, you can also look for where are the mispricings? Where can I find where in the market are the pockets where there is a lot of inefficiency? And that's the yin. And so what I do now is I combine both. Um, if, for example, in a couple of years, I don't know when there's a big downturn, then I can look at my quality yang companies and try to buy some of them at a very good price. But in the meantime, I'm more focused on the yin because that's where the opportunities lie.
Yeah, and I think too, it's like it's where everything's going. It's the direction
Yeah.
of, right. So I mean, for example, on my Substack, we have a 10-point quality list that we've actually put together a geo first, and we use it for the Substack
Mhm.
of quality, and then we have another like maybe 8, 10 multi-bagger checklist, and there's this kind of talk out there about quality, 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 profitable, profitable, profitable. But like you said, I mean, if the company is looking too good, and it's going to be priced in many times. And it's not just enough to be profitable too. If you're profitable and not growing, maybe you're still cheap to some degree, but you're not going to have this huge multi-bagger move unless you're some kind of change is going on to dramatically affect the current valuation, right? And so when people take that quality list literally, and this is I guess this is the yin part of your strategy is like we're similar in that we're looking for stocks moving toward that quality kind of
Hmm.
checklist. Not necessarily they got to be 100% quality right now. There's
Yeah, it's more
and
about the direction. It's more about
correct.
where
Yeah,
it's going, and that's where you are now.
your best stocks are going to be those ones that kind of the market hasn't just quite figured out yet. They don't
Yeah.
believe they're just everyone's thinking differently than you about this maybe a turnaround, right? And or maybe a spin-off like you have here, and maybe it's complicated to kind of analyze, so or it seems complex to people and they ignore it, which gives you this time embargo to go in there and do some homework and hopefully you'll be right. Um, so I enjoy that part of it. I know when I first started, Kevin, it was like I didn't want to I was afraid to go that direction. I was afraid to go in the ends.
Yeah.
And I remember my first time, like you come out of you read all these books, like you said, you read all the books. You read a lot, net nets, valuation. You're looking at deep value, all these things, and you start figuring out that it's when you find these great companies, they're not selling at these valuations. And you never buy
No.
anything. Well, so you're forced to go down a little bit underneath that to find some of that hidden value.
Yeah, sure.
And I think that's what you're talking about here. And you said your expertise is nuclear, but lots of hype and talk. Um,
Yeah.
I guess you tried looking in the nuclear area for a little bit, see if you could find something because that's your expertise. Is that what I'm hearing?
No, the idea there was I hear a lot of people talk about investing in nuclear, maybe nuclear stocks or nuclear companies, but there's a lot of hype surrounding it. Because
Mhm.
I'm in the industry, and before someone comes in and starts putting down checks of a couple of $1 billion, we're not there yet. So
Right.
yeah, I just because of one of the questions, what is your expertise? What my expertise in nuclear industry? But I'm not specifically. I do look around in the nuclear industry, but I don't think there are many great opportunities in there. Um,
Okay. So
it's
I think
still
it's
too early. It's still too early.
I think so. Yeah, I own one stock. I think it was GV or GVP. I forget the name of it. They just got acquired, but it was they did I think maintenance for nuclear sites, and
Ah,
then
okay, it's possible. Yeah, I don't know them.
simulation didn't do too hot. So that they recently got acquired, but I don't think it was a great exit. So you have this thing here. I like this. Don't give me advice. Tell me what you're buying. I like that.
Yeah,
Uh,
I stole that from somebody on Twitter who has it. It's its only thing in his bio. But I think it's interesting because when people even I did a presentation 2 weeks ago at the investor conference here locally, and after the investment conference, somebody said the same thing. I said, "Okay, you gave me 1 hour presentation with a lot of advice. Tell me what you're buying." I think it's great because it can be a lot of blah blah, but in the end, where are you putting your money? I mean, uh,
Yeah, that's true too. I mean, you can sound anybody can sound like an expert, right? We can
yeah,
say,
sure, yeah,
but yeah. So let's start getting more into some of your stuff here. And you say you're actually you did say we kind of touched on this already, but you say you're market cap agnostic, but you
yeah.
but you still have a propensity to invest in the smaller stuff, right?
Yeah. I think for the moment it's like 70/30. It's like most of my time goes into the real small stuff, like the microcaps, sub 100 million. But I don't shy away if somebody pitches me an idea or I find an idea in the 5 billion or 10 billion, I will take a look at it. Because the problem with the other part of the strategy of the quality compounders, the only thing I feel about it is that when a quality company is priced is trading at a good price, usually it's because of a short-term downturn in the company or maybe in the sector. Um, but to write down the investment thesis to answer the question, is this time a short-term and non-permanent? So is this really short term? I find that difficult. I find that more difficult than finding a microcap where on the surface it doesn't look good, but when you go into the reports and in the news, you see that things are changing. The thesis becomes easier. And yeah, it's I don't know if you know the Heisenberg principle. It's come from quantum mechanics, but
No,
yeah, in
no.
fact, yeah, it's the same thing in quantum mechanics. They say that a particle or a really smart particle, you can never know the speed and the location at the same time with precision. It's impossible. It's like a fundamental law of physics. And it's a bit the same when you're looking at microcaps. You have to look very hard so you have to go through lots and lots and lots of companies. But when you do find an opportunity, the thesis is easier.
Mhm.
And inversely, for a quality compounder, it's the other way around. You can find them easily. I think anyone, each investor, you ask them, show me a quality company, and they can give you a well-known quality company. Um, but the thesis or the analysis to show that it's an opportunity is a lot more difficult.
Mhm. Love it, love it.
So
Bring some
yeah,
physics into here.
yeah. I have to use my background.
Well, um, on the process, so let's talk about your edge a little bit. I mean, just investing in microcaps can just give you a natural edge. But there still is I think, difficulty investing within microcaps. Just because you invest in microcaps doesn't mean you're going to be a successful investor, right?
No,
And I think so. Let's get into this. You have behavioral, process, and informationalist, kind of three bullet
yeah,
points put there. I think that's quite interesting, especially in behavioral, which is I think I agree with you there. So maybe unpack those three bullet points for us in terms of how you view them.
yeah. I think it's a great question to ask yourself what is your edge as an investor because we're always looking at what is the competitive advantage of one company towards all the others. But investors are also competing with each other. When I buy, there's a seller at the other end and the other way around. And so I think it was Bill Miller as a value investor. He wrote a piece in an interview. He talked about the edge of an investor and he broke it down into three topics. So the behavioral, process, and informational. So informational is the easiest one. It means I got information that you don't have, and this gives me an edge. Now, the problem is this may have been the case when Buffett was young or a long time ago, but here at this time, it's a lot more difficult. The only thing maybe I saw over the last years in the microcap space is there seems to be sometimes a slight edge in informational aspects when hunting in microcaps because it's like the information flow because of the high illiquidity, it's slower. And I have seen situations where some information is published and you really had about 24 hours to react as an investor, and that's something you don't have when you're in the large cap space. So that's the informational part. Then the process is the way you process that information. And I have a pretty strict process for my analysis on the companies, but um, well, yeah, I'm not going to claim that it's going to give me a big edge because I don't know if my process is that much different or better than any other process that other investors have. The only thing
Mhm.
I do is because I'm market cap agnostic and because I try to look at almost everything. My process is mostly based on making blueprints of what a good situation looks like. So, for example, what is a good net company, or what is a great spin-off, or what is a great turnaround? Because when you do that, it's like um, when you go to like a local yard sale and you want to go for bargain hunting, you first have to know what you're looking for. And if you don't know precisely what you're looking for or what good looks like, then you can't say no to everything that you come across. So I think that's
Right.
very important.
Yeah, I think that's and I've had a mental checklist in my mind, for years, and when we did this Substack, we finally put it to paper, but it definitely helps to have that. And but you learn a lot
Yeah,
of that
sure.
by going through. and reading reading reports. I'm a big fan, like when you said earlier about but reading the press releases, reading the transcripts, reading the filings. As an investor, I think you start learning more about investing and what works just by reading these things. And it's knowledge that compounds over time. And the earlier you start doing that, the better. But you start recognizing these
Mhm.
patterns over and over again, where um, it just becomes at some point, okay, you start seeing these patterns. How do you believe management? Which is
Mhm.
another tricky part about investing. But I totally agree with you on that.
Yeah, I think your point on pattern recognition is spot on because you can feel it when you continue investing, reading. It's like something clicks when you find a company or an analysis. You start to see things that maybe you can't really capture purely analytical because I'm from an engineering background. So when I started, it was pure about the analytics. But now in my checklists, I always end with what does the gut say? What does the gut feeling say about this investment? And in the past, I said no to investments that based purely analytical looked good, but there was something about it that I couldn't really capture why. But
Mhm.
and I think that's really the result of the pattern recognition.
Absolutely, absolutely. You know, sometimes you just know. I mean, it sounds crazy, but the sixth sense where you come across a
Yeah.
story, and like, you know, that I just don't, I don't believe that management team, where I believe this guy, and you get goosebumps when you hear the good story. You just know right away. Your body just tells you, well, this is gonna be incredible. Yeah, I know, for example, when I'm reading these conference call transcripts, I'm really trying to understand to see if the CEO. I love the beginning of these the beginning of the earnings transcript when you're hearing the CEO kind of present
Hmm.
the earnings, and I love hearing that intro just to hear kind of how unique they are in the delivery, how well they know the company, how well they know the industry. And sometimes you come across these transcripts where it's just so much information that this he was talking about, which you can understand his expertise and passion, and start believing, you know, what they're saying there. I love that intro, and that's one of my. I look at the intro and then the end. How do they end that conference call, that transcript, and how do they begin it? And I love hearing especially those new CEOs that come to take over a company, and you hear that passion and their
Hmm.
understanding of the business industry in the transcripts. Really important to look for those kind of clues.
Yeah, because usually I like reading instead of listening just because it goes faster. But I will always put the effort in. If I really like the company, I will put the effort in to at least once or twice hear the transcript just to get the feel on like non-verbal things like
Mm-hmm.
how did they present, try to read between the lines because what is in the text I can just read it, but I need to feel um yeah how the person behaves.
Right. You know, and
Yeah,
it's
and
like, go
then
ahead,
maybe
sorry.
the last one I didn't mention, it's the behavioral edge, but I think one of the things I learned from a behavioral standpoint is just to embrace volatility. And especially in the microcap space, if you can't consider volatility your friend, I think you cannot win in microcap space. I mean, I have companies that sometimes from one day to another, because of the illiquidity, they increase 50%. There was no news. I mean, if you can't cope with that or decrease, increase is easy, but if they fall 50% for no reason, I mean, you have to be able to cope with that.
Absolutely. I mean, a buddy of mine called me a few days ago for, hey, yeah, just looking for some 5 year favorite picks. So, yeah, so I gave him, you know, 5 stocks, and he went and bought them. And at the risk of saying, hey, you know, do your own homework. But he bought it. 5 minutes later, oh my God, the stock's right down 10%. I was like, dude, well, what's wrong
Yeah.
with you? Well, now it's up 20%. But it's funny how that people will say it too. People will say, and even we go through this. I remember, oh, I can handle volatility. I'm going to be okay with it. Value, the only thing that matters is value, what the stock is worth. I'll handle a crash. But when you're really in it, it's not as it's a different
Not the
story.
same thing.
We all say it when things are going great. Um,
Yeah.
but the behavioral now, I think also something I thought about, Kevin, was um, like the behavioral attitude towards investing, a lot of it also can be shaped by have you put yourself in the position to be psychotic? Have you gone
Yeah.
on margin, for example, or is your personal life financial situation intact where it's not going to drive you crazy? Um, that's something I've learned over time too. Um, but I know one of the things I like to ask, and I just thought about asking myself, we've always said, what are our edges, but what are our weaknesses? Like where am I bad at investing?
Mm.
And understanding where I'm bad could help me kind of improve the edges, I think, a little bit. So
Yeah,
I
because
understand that I don't like to watch volatility, so I don't.
mhm.
I don't like to watch my portfolio, so I don't.
Yeah, but
um,
I have the same thing. I think a couple of weeks ago, I did a poll on my Substack to ask my readers, how many times do you check your investments? And like, I think 80% is daily, or even multiple times per day. And I
right.
said to them, I look at them from time to time per quarter. If you ask me now, what is the return I have now? What are all my investments doing at this time? I can't tell you it with precision. And
Right.
they and some said to me, because I had the investor presentation and drink afterwards, and some came up to me and they said I was crazy. I mean, but I have to do it, because if I don't, I'm going to make bad decisions. And as you said, one of the biggest things in investing is self-awareness.
Mhm.
You need to be self-aware, and what are your pitfalls and your weaknesses, because else, yeah.
Absolutely. And I
And
think that's I got you, everyone. I think everyone should do that practice. I mean, it's going to be it's a long list for me. And
yeah, of
now
course.
I either got to correct them or ignore them. I don't know. We'll see with how I go through it. But
Yeah, but even if the list is long, it doesn't matter if you're aware. That's the beauty of it. It's not knowing it's the problem.
all right, so let's look at some of your processes here and some of the things we'd like to talk about often on the show. I want to jump actually to concentration versus diversification. That's one of the hot topics I like to talk about.
Hmm.
And um, and then again, we say there's no one way to invest. It's about asking yourself, and this is what you're good in, what you're good at, what you think your edge is, weaknesses, strengths. So I have some things to say about that on this topic. So let's hear what your concentration versus diversification type of philosophy here, and how you look at that.
Yeah, sure. Yeah, from a diversification point of view, one of the things I consider is that even one business can be diversified, as long as it has, maybe it's a business that does business worldwide at different clients, different business lines. So it's not just, I think it's an important aspect. It's not just about having 50 companies in your portfolio and thinking you're diversified. So that's one thing. I run a pretty concentrated portfolio. I mean, like I have 12, 11 or 12 holdings. Um, Maybe I would go up until 15, but not beyond, because I prefer fewer holdings, I can go deep into, than starting to dilute the entire portfolio with like 20 or 30 holdings. And even for an investor like me, I mean, I'm a part-time investor, so I spend about 20 hours a week, which is still a lot. My wife calls me a bit obsessive, but I mean, she she says, you love what you do, so if you're happy with it, when you love what you do, then it's okay. Um, and I can't imagine going beyond that number.
Mm-hmm. That's right. Yeah. So now I know I've gone back and forth on this a lot personally through my career. Uh, and I came off of reading Peter Lynch's book, One Up on Wall Street, and he had thousands of stocks.
Yeah.
This to me was for my reflection was who I am and what I like doing. I just like it so much. It's like a kid in a candy jar for me. So, and I want to I kind of want to handicap my weaknesses in terms of maybe sometimes I don't want to go too deep into a company and but I want to own it.
Hmm.
So I've done both. I've gone very diversified in my first two decades of my kind of career path. then I became very concentrated. Now I'm getting very diversified now. So I think they both can work. Um,
Yeah, sure.
but what I
But
found,
I think maybe what's important too is when I started investing, when the people say buy, hold, and sell, it's like it's a discrete thing you do, but then um, with experience, it's more like initial buy, add, and then
Mhm.
when you lose confidence, trim. Maybe
Right.
if something significant happens, okay, you outright sell, but it's rare, and it's more like a continuous process
Hmm.
than discrete. And this also has an impact on the concentration you have because you usually what I didn't do before, but what I start doing now is if I analyze a company and something clicks with the company, even though I didn't spend, maybe I spent only 1 or 2 hours, I just take an initial position of 1%, and then afterwards I will add to it if it's more interesting. Instead of in the past, what I would have done is, yeah, I say, okay, I'll put it on the watch list, keep doing work on it, and then maybe, I mean, 1 or 2 weeks later, I will put a position in. But I feel better now doing like these initial buys.
I think you wrote about that in your Substack a few articles ago.
Yeah, I think so. Yeah,
Yeah,
yeah.
I was reading that. I'm the same way. I like, taking those. I've always been pretty quick to the trigger. If I like a company, the first few innings, I'm gonna go buy some stock in it
Hmm.
and let it marinate a little bit. And that's what I found too is like, so when you look at my index and we created an index at our Substack, MSMQI. It's a microcap quality index. Um, and there's 102 stocks in there right now. We launched it in February of 22, the actual index itself. But if you would have asked me, on day one, who those top 10 would have been, I wouldn't have really predicted it correctly. I would have been way off.
Yeah,
And
okay.
so I'm actually writing an article on this right now, trying to, the advantages of concentration and the advantages of diversification. And right now I'm on the diversification advantages and disadvantages too, and making that list for the article. And one of the things I've realized from having the index is that it kind of allows me to invest without being worried because I'm not going to
Hmm.
get dramatically hurt by one position if it's an equally weighted scenario. So
Yeah.
on day one, starting to build this equally weighted index. It also allows me to invest in areas I probably wouldn't normally invest in. So let's say I want to get exposure to the oil and gas. It's not my forte, right? I just don't like it because it's unpredictable, but maybe there's pieces of a story that seem interesting to me. I'm not going to be an expert in it, but okay, I'm going to get exposure to maybe two or three stocks at a 0.5% position in this whole thing. And one of those stocks ended up being in the top 10 performers of the index at one point. I would never have predicted it. It was a shitty turnaround company. So it allows me to go outside the box a little bit and have some fun there. Um, and it allows me just to watch these stories marinate and then add to them as you go along. And if you're, but I think diversification, or even in any situation, it only works if you're good, if you're decent. You have to be at a high hit rate, maybe a 70%, because then diversification will probably get that law of diminishing returns. You have to hope that you're going to have these multi-baggers that come through eventually to really make it worth your while.
Yeah, of course, of course.
And I
But I
think
think
that
it's very personal. I mean,
yeah, it is, yeah,
you need
yeah.
you need to align your concentration strategy to who you are as a person. Because if you only have 10 stocks, automatically you will have a lot of volatility. And if you can't cope with that, don't do it. I mean,
Right.
it's madness.
I like waking up and like, oh wow, that's great. That stock's up, 50%. It's
Yeah,
like a surprise. It's like a surprise to me. I felt that about like it's been a good 2 years and a year and a half in the market. Um,
yeah. I think the index is performing well. Huh? I think.
yeah, yeah. The market's doing well too.
Yeah,
So
yeah, sure.
the question becomes is when the market's tanking, I'm curious how it's going to perform. Diversification.
Yeah,
It's going to go down. You're basically the market, but if you're a good investor, you're going to get alpha on the way up. And I assume on the way down, maybe even fall further because there might be some volatility there.
Yeah, it could be.
than
Yeah.
the index. So I'm wondering if a concentrated portfolio might do better in a downturn. I don't know if because if you've done your homework, it's hard to say, right? I just don't know which way ends up being the best way, if there is a best way, right? And I think it becomes very a personal decision, like we said.
Yeah, and I think also based. I mean, you can talk about the number, but what is it? For example, I have one big net in my portfolio. If there is a downturn, I'm expecting it won't move a lot. It
Mm-hmm.
might go down a little, but I mean, it's rich in cash. I mean, there's no reason why it should go down massively like compared to the market. So you have the number, but then you have what is it? What are the numbers? And I think it plays a huge role.
Excellent. You own about, I think, 12 stocks you're saying here. So you're more of
Yeah.
a concentrated investor, but you have a top three holdings, about 40% of your position. So you're very concentrated within that
Hmm.
concentration on your top three holdings.
Yeah.
Now, and what's top? I mean, you don't really, we don't have, I guess you do with long-term versus short-term investing. I was going to ask about your self-discipline, but I don't think you're not are you defining your holding period right away? You're just buying a stock until you think you shouldn't own it anymore. How do you view that long term versus short term type of investment decision, or does it even matter to you at all?
No, typically, if it's something in the yang or in the quality space, if I can buy something in the quality space, normally it's with a longer term view, and for me, a longer term view is 5 years or more.
Mhm.
Um, but it doesn't happen often. I think the last buy I did in the quality space as a compounder was a company called Adyen, is a payment processor.
Mm-hmm.
Um, when it dipped, I think it dipped like 40 or 50% last year because of some negative news on quarterly earnings. And I went in, um, and then it has recovered since then, so it has been a double. But I mean, I'm not planning. You could say for the moment, if you do a pure valuation exercise on a company, that it seems overvalued. But if the quality is so high, the management is so high, it has a clear competitive advantage. I'm trying to stay away from the valuation as much as I can because I'm
Mm-hmm.
I'm afraid of selling it too soon.
Correct. I
But
think one of those things too. I ask myself when I'm looking at a longer term holding like that is, maybe it's fair now, but is it ridiculously cheap 5 years from now? Maybe at this current price.
yeah, maybe. Yeah.
That's one way of looking at it. I think sometimes, and sometimes
Yeah.
some stocks are just always going to be priced above normal because they might just be great companies.
Yeah, and what you see with the best companies or the great quality companies, there's a lot of hidden optionality in there. And that's things you can't value.
Love that.
And
Yeah.
and yeah, and that's why I try not to sell based on valuation. For the like for the microcaps or for the special situation things in the yin, it's different because you're you have a certain you have a certain framework and you're saying, okay, maybe there's like a hidden movement, an inflection ongoing, and within 2 years it will earn a certain operating profit,
Hmm.
and you try to estimate it. If it happens within those 2 years and it reaches that level, then you have to reassess. It could be that I'll sell if I don't see any other future for the company, but it really depends on you have to reassess on that point. And but it's a lot shorter term because if you estimate something happening within 2 years and 2 years later nothing has happened, it could be the thesis is broken. I mean, it's a
Right.
lot more shorter term.
Absolutely. So when you do the short term stuff though, in the yin strategy, but you also have some inflection point investing. You do that.
Hmm.
So when you're looking for change, are you at times going into it? Hey, I know here's a short term change that's going to happen. I'm going to ride it for this long, or is that how you're approaching it, or you're finding change and then holding it till it just doesn't work anymore? Are you?
Yeah, I mean, I have invested in like an arbitrage opportunity, and that's like simple. You have like you see like a certain opportunity. It has a certain date in time, and so that's very clear. And at the date, it should resolve itself. If it doesn't resolve, then you sell. I mean, that's
Okay.
the more clear-cut answer.
Mm-hmm.
Um, But there are other situations where, for example, with the company that's on the slide, Innovative Food Holdings. I
Mm-hmm.
mean, that's like inside the company, a lot of good stuff is going on, but when you look at a screener, it looks bad.
Mm-hmm.
And so what I expect is that once screening starts to look good,
Right.
then something will happen.
Yeah.
And then afterwards, I would like to be able to keep the company if it's really growing and there's quality inside. But it could also be that it's just a couple of quarters that you just gain some alpha and then it's over.
Mm-hmm.
And yeah, you need really. I think the difference with the two strategies, with the inflection and the yin side and the yang side, is for the yin side you need to follow the companies a lot closer. You need to
Mm-hmm.
really you can't drop the ball, go quarter for quarter, and make sure that things are going as you expected it to be.
Mm-hmm.
Yeah,
Excellent. You do invest in special situations, which also can be inflection point type of investing too.
yeah,
Um, but you say you don't invest in bankruptcy or distressed assets at all, or kind of
yeah, but because
exits. Okay.
yeah, it's a bit too complicated. It needs to be simple to understand. I don't have a big background in bankruptcy law, etc., and so there are things I try to avoid because it's just too complicated. Yeah.
Okay. Are there certain industries you would just avoid in general, Kevin, too? I mean,
Yeah,
besides.
mostly commodities, biotech, pharmaceuticals, and
Mm,
yeah, financials. But and that's because I'm not, I don't know enough about banking. But because when we had the implosion of the Silicon Valley Bank, I think 2 years ago now,
mm-hmm,
um, I when something like that happens, I'm looking at the entire market for the small banks in the US at the time to see, okay, isn't there any opportunity? Are there quality banks that are thrown out with the bathwater with all the rest?
mm-hmm,
And I had one bank in my eye, but because of the lack of experience in the investing in finance realm, I didn't pull the trigger. And so
mm-hmm.
my goal for example, in 2025 is I would like to expand my like Buffett says, circle of competence, study a little more about banks to have that on my skill set.
Okay.
Yeah.
Excellent. So, before we get into the pitch, anything else you want to talk about on the process that we missed here?
No, I think we covered a lot of ground.
Great.
Yeah.
Excellent. So, I guess you have your favorite stock in 90 seconds and uh, IVFH, Innovative Food Holdings. So, why don't you tell us about Innovative Food and why you like it?
Yeah, first maybe a little shout out to Sebastian Krog. I think you know him, but he's the one who wrote about it, and it's through him that I learned about the company.
Mm-hmm.
Um, why I like the company is they always say that you shouldn't invest in turnarounds, but this is for me the blueprint of a good turnaround. And the reason is you sometimes see turnarounds where people come, new management comes in, tries to change things, and usually what they do is they reduce costs, or they differentiate their products, or they invest in marketing and sales, or something like that. But the problem with those kind of things is it's not structural. It's like, why didn't the management before do this? And in the case of Innovative Food Holdings, they had, in summary, they had a good business and a bad business. But when you look at a screener or any screener, you see the revenue going down, you see the profit going down. But if you look deeper, you can see that the good business is still doing fine, and it's the bad business that is deteriorating. And in this case, it was they venued into the e-commerce B2C at a certain times were very costly. Never they were never had any profits. Its growth was stalling. And so what happened is that a new, very experienced management team came in. They also had skin in the game because they bought into the company. They divested the bad business so that only the good business remains. And now they are focused on growing that good business side. And I think I wrote about this in an article in the past, I think maybe 6 months ago. It's divesting is probably my favorite capital allocation skill because, I mean, if you're running a business and you're creating, for example, like this an e-commerce business, there's an enormous amount of commitment bias. You're investing time and energy, and to say at the end, like after 5 years, if it's not going well, to decide, no, we're just going to sell this part or just divest it is incredibly hard psychologically. And so when I see a company doing some divestments, I'm always interested. And that's the main thing here for innovative food holdings. They have really they changed the business structurally. They have been growing the last year, and I think they're on the path towards some great things. And I think last week they mentioned that they're going to do a reverse stock split because for the moment they are on the OTC markets, but they want to go more up higher into the Nasdaq. I think to get more attention from
Yeah, I think they did a,
more.
like a very small raise. I'm going to do uplist and a reverse split.
Yeah.
And I think they made a couple acquisitions, or was it just one recently?
Yeah,
So
yeah.
now they're kind of out of that first stage of the restructuring. Now they're
Mm,
stable. They can actually start putting some growth, some more, inorganic growth on top of everything. So it seems to be going really well.
yeah.
Um,
One of the good things also is the CEO. He was like the VP at Kroger's before he came into the company, but that's like a pretty big position. And so this means he gave up something pretty big to go into a small company to put himself out there with skin in the game. You're not doing that for the fun of it. I mean, you're doing that because you're driven, because you want to accomplish something, and that's also one of the reasons why I think it was a great. Well, I mean, I think it's a great investment.
so excellent, beautiful, beautiful. Have you had it for around since Sebastian wrote about it, or have you had it before that? I think you said you found
Imme-
it.
no. It's just afterwards.
Right.
I mean,
Okay.
I think a month or two afterwards, I wanted to do my own due diligence before going into it, and yeah.
Okay. Great. Excellent. Well, that's been awesome, Kevin. I'm glad you shared that pitch with us. And I think we covered it all today. Um, this has been a great time here. We've been here with Kevin Schoovaerts
Schoovaerts, yes,
uh,
no problem.
uh, at atmosinvest.com is your Substack.
Yeah,
And I really encourage everyone out there, if you're not on Substack, join it and make Kevin one of your followers or follows. And if you are on Substack, definitely follow him. So you got some great material there to read through on process and stock picks. So I really enjoy what you're doing there. So quality lives on.
yeah. Thanks so much. Thanks for inviting me.
Thanks,
Thanks.
Kevin.